Welcome, everyone, to the Rocky Mountain Twin Counties 2017 Economic Outlook. My name is Kenneth Hunter. I'm excited to give you all this information, which is a tie-in of information at the national level, regional level, as well as local level. Look at where we have been and where we're going in 2017. First of all, there's a lot of different sources where this information comes from. A lot of this information is out there. Most of it's free. Some of the more detailed information is not. There is a lot of proprietary information at that point, but you'll see a lot of different resources used. I also want to be very specific and thank Kathy Akers, who's a realtor with Boone Hill, Allen & Ricks Real Estate. She does a very good job every year of providing information on annual housing activity here in the Rocky Mount MLS market, and we incorporate that into this report. So I do thank her very much, and for her firm for providing that information through their MLS subscription. So where are we doing? The key themes, there's about 50 or so slides, so I will be going very quickly through this presentation. The key themes that we're going to look at, take a look at where we are right now, the metrics of optimism. Overall, there's kind of seems to be a spirit of optimism. Maybe the last 2 days on the market don't show that, but prior to, I guess, Monday, there was kind of a forward optimism that was being shown in large part since the elections in November. And of course, where are we going? We push beyond that new normal that we've experienced since the recession of 2007 to 2009, particularly in Rocky Mountain, trying to look at where we are and seeing, are we starting to see that resurgence, that recovery that we've been waiting for since that recession that started in 2007 that ran through 2009? Really see, are we starting to see the growth in Rocky Mountain, the Twin Counties? And then share with you some predictions that have been made by other economists and by other groups as they've tried to look at, where are we economically speaking? So we'll go ahead and get started. Taking a look at the metrics of optimism. And if you were to look at the press, particularly the business press, the overall press, is a little more mixed and shows a lot more volatility in their coverage, but especially in the months since Donald Trump's election as president, not making any political comments or political statements. Generally, there has been some optimism from an economic perspective. There may not be optimism in other areas, but there has been some shared economic optimism. And all of these headlines that you see there come from reputable news outlets. They're not coming from, these sites, these quote unquote fake news sites that sprouted up prior to the election. These are from reputable news sites. And you can see that there are a lot of people who are excited about some of the things that the administration of President Trump mean with respect to the overall economy. There's feeling that that his administration, along with a Republican control of the House and the Senate in Washington, are going to lead to lower taxes, to some changes in tax law, particularly in corporate taxes, but also as well to regulatory reform. We saw that yesterday with an executive order that he adopted. So there's a lot of optimism out there, and it has spurred some activity, but it also kind of gives us an idea of where is that compared to where exactly we are. And going to the next one. So let's look at where we are nationally right now. Last week, we had the latest update to quarterly update to GDP, basically seeing where we were at the end of 2016. Overall, annualized GDP, I look at it from a real perspective to take care of and adjust for inflation, was around 16.8 trillion. You can see that it's grown about $2 trillion in terms of overall value, or by about a seventh, or about a little less than seventh, probably by about an eighth, since where we were in 2007, 2008, prior to the recession. We lost a significant amount of GDP during that time, and it's taken a while to recover. When you look at it from an annual growth rate, however, you can see that we continue to kind of lag, particularly in the last 2 years. This is annual growth, and for the last 2 years, for 2015 and 2016, our growth is at about a little less than 2%. And when we take into consideration the long-term average that we had from about 1980 until about 2005, 2006, that 25-year period, our annual growth rate was at 3%. So our annual growth has been cut by a third in terms of where the average has been, that kind of new normal average that we have seen in this post-recession recovery. Now, the important thing to remember is when you look at how long that period of recovery has been, we have had a very long period of positive GDP growth. This has sometimes made people wonder, when is that period going to end? I'll go ahead and say this up front, that the economists do not expect there to be a downturn this year, and probably not a downturn next year. So 2017, they're pretty confident there's not going to be a downturn. They do expect GDP to pick up a little bit, but they do not expect a downturn this year or next year. At some time, however, because economies are cyclical, at some point there is going to be a downturn. And the question is, when will that be? And two, how significant of a downturn will it be? But for right now, the next 2 years, it does not appear that there's going to be a downturn, at least from the perspective of economic research. We've talked about, the other thing I like to look at is looking at gross domestic product per capita. We are a growing population with respect to population, and so our ability to continue to grow our per capita GDP at the same time we grow our population is an indication that we continue to grow our productivity. And annualized at the end of 2016, we were just a little under $52,000 per capita. So that for the year, it had grown about 1.2%. And that's kind of been the rate of growth. It's been around a little over 1% for the last couple of years. It was higher in the pre-recession period, but it is something to kind of keep in mind, because of course that also goes back to wages, it goes back to income, it goes back to personal wealth, it goes back to some other elements of GDP that we need to be aware of. And I know that there are a lot of people out there who think, particularly at the individual level, when you think about the states that Trump won in November, when he won particularly in the Rust Belt states, Ohio, Pennsylvania, Michigan, and others, those are the people who are hoping that this growth, this post-recession growth, which has mostly been in the markets and has been in some elements of the economy that they necessarily haven't seen the direct benefit of, that they're hoping that they're going to now see some of that economic growth come to them from the standpoint of higher wages, more job prospects, greater job prospects, and increased personal wealth. We'll have to see if that happens, of course. Of course, one factor that does impact GDP, of course, is inflation. And generally speaking, inflation has been relatively calm in the post-recession period, with the exception of energy prices. And the red line that you see right there with the CPI of Consumer Price Index is for all items. And then the blue line is what they call core CPI, which of course they remove food and energy, in part because food and energy historically have a higher degree of volatility with them. There is the chance for food price spikes. We don't see that as much as we used to. We occasionally see it, like last year there was a little bit of a period of inflation with respect to egg prices because of some loss of some hatcheries. Sometimes pork prices, particularly with meats, porks, cattle, those prices have a little more volatility. But in general, food prices are relatively stable, but energy's not. And we especially know that during the recession and the lead up to the recession, there was a tremendous spike in energy prices. That kind of calmed down, and it has especially calmed down the last couple of years. We're starting to see it pick up a little again. But as you can see, that gap has started to widen significantly. And what that reflects is that we are starting to see more inflation in other types of consumer goods. And it's also being driven a lot by healthcare costs. Healthcare costs continue to rise, as does housing. So healthcare and housing are now starting to push up inflation a little bit and kind of take up that gap where food and energy was a couple of years back. Looking at producer price index, actually, I'm sorry, this should say CPI. I apologize for that. It should say CPI, as you can see for 2016 on an annual basis, all items 2.1%, less food and energy 2.2%. So there are now other contributing factors to inflation other than food and energy. This chart shows annual increase, shows you the impact of a 12-month increase. This is the producer price index. This is what businesses, of course, pay, and manufacturers pay for production of goods and services. And you can see that index is actually still below where it was, I guess, during peak energy prices from 2011 to 2015. As energy prices have kind of gone down in mid-2014 to where they are today, that's helped reduce the producer price index. There's some other commodity prices that have also gone down. And overall, for the year, it's up about 2.6%, but it's still below where it was about 3 to 4 years ago. So that's a okay sign for businesses. Obviously, they would like to see those prices stay relatively stable so they can try to catch up on some of their other costs. Looking more particularly at certain elements of the economy and prices, crude, you look at where we were. This is a 12-month chart, and you can see that we've now it's kind of a good thing in that the top for the last actually more than 12 months, about I guess 13, 14 months, is at $58 a barrel. We can all remember a couple of years ago where that top number would have been over $100 to $110 a barrel. So the fact that we're at $53 compared to where we were a couple of years ago is not bad. However, when you look at the fact that it has gone up about $8 a barrel in just the last 12 months, or about an 18% increase compared to where we were 12 months ago, the thing to remember is that the price is not going to go down probably much further. If it went down much further, that would not necessarily be a good economic sign. And the price does need to stay up so that we can promote additional forms of exploration, particularly domestic exploration, which is more expensive. The shale exploration, the sand exploration in North Dakota and other areas, that is of a higher cost for production. So prices do have to stay up to be able to facilitate that exploration going forward. Natural gas, on the other hand, fracking and other sources have continued to keep prices down. The other factor on natural gas as well is weather. And last year's winter was relatively mild nationwide. This year's winter is looking relatively mild nationwide, and that also is keeping costs down. You can see we have had some craters below $3. Where we are now at 314 is a little lower than where we were a month ago, and about on average we're a little lower than we were 12 months ago, and that's helped keep the cost of natural gas for heating down. It's also helped keep electricity costs down because a lot of electricity is produced, particularly at peak demand periods, using natural gas generation. Of course, when we talk about crude, obviously for most of us, crude leads to gasoline. Gasoline prices have gone up in the last year. We're about 50 cents per gallon nationally higher than we were about 12 months ago. Again, compared to the days of paying for $3 gas, it doesn't look as bad. We've kind of accepted, but at the same time, when you think about, for a lot of people, particularly families and older people, I would say those in the 40 plus population who are more likely to commute longer distances for work, higher gas prices does have an effect on personal spending and personal consumption, the discretionary income they have for other types of spending. So it is something we have to monitor. Of course, it also factors into the cost of logistical operations, shipping, and other activities. You can see I also include the blue. The red for North Carolina. North Carolina is about 10 cents, a little more than about 10 cents down below the national average right now. That gap does increase a little bit more in the spring when you start seeing significantly higher prices on the West Coast due to their gasoline standards. And again, South Carolina in the green because of lower gasoline taxes is right at about $2. One of note, Tennessee, which is another state that has lower gasoline taxes, it's a neighbor of us, is looking at a significant gas tax increase this year. Possibly, they haven't said that they're going to do it, but the governor has proposed it as part of his budget proposal to help pay for highway spending. So that is something that would affect us to the west, but obviously to the south, it's more than likely that South Carolina is not going to be changing their gasoline tax anytime soon. I mentioned electricity. These are charts. These charts are from the Energy Information Administration, federal agency, just to kind of give you an idea of electric cost. And the blue lines are actually from November of this year compared to the gold line or brown line, which is November of last year. And you can look, the South Atlantic includes North Carolina and Virginia, and you can actually see that those costs are actually down a little bit. And this is the cost per kilowatt hour. And when you look at residential, the average is it's about 11.5 cents, and it's gone down about I think it's about 3/100ths of a cent or less than 1/10 of 1 cent, but about 3/100ths of a cent in the last 12 months. What that's an indication overall is that prices in general are staying about the same. And again, this is being led in large part due to the low cost for natural gas and other commodities that are used for generation, particularly natural gas. That's primarily the direction that a lot of generating capacity is going to in today's world as areas start to expand their electricity production to meet demand. Now, of course, when you take all those factors in consideration, you look at the market. the momentum continues. A lot of people like to talk about Dow 20,000. I prefer to look at the S&P because there's an easier way of looking at sectors of the S&P, the use of ETFs and other things. And it kind of gives you an idea in general about how the economy is going on. I'm not a market expert. I don't do trading or things like that. I use it more as a tool to measure kind of the general health of the corporate sector. And as we can see, it continues to grow. Some people would argue that this growth has been facilitated by the injection of capital from the Federal Reserve into the markets. That was what happened after the housing bailout. Of course, that's the area marked in the blue, that recessionary period where the market dropped significantly. The S&P actually went down to below 700 at one point in 2009, and it's now all the way back up into the 2,300 range. And a lot of that people would say is that that's really where the inflation has been, whereas the money hasn't been injected into the consumer economy. So you haven't seen as much inflation because there's not as much cash there. The cash has gone into the market and has pushed market prices up on stocks. Those are what some people say who look at it a lot closer than I do. Overall, the 1 year change in the S&P is at about 18%. That's pretty good. So if you are someone who's an active investor, you've seen some growth this year. As you can see, back in 2016, however, that wasn't the case. We finished 2016 actually at a loss, at a lower level. So that 18% helped recover your losses from 16, and you still ended up ahead. But it is something to keep in mind that, there are times for correction. And I'm going to go ahead and say it. There's likely going to be a correction this spring between now and probably the beginning or the end of spring. There's going to be a correction because the market, it's time for it. There's just been a lot of continued momentum. Doesn't mean, however, that we're going to finish out the year behind. We could go through this correction and we could continue on a growth track by the end of the year. But at some point, there's going to be correction because there's just been too much growth. Typically, when the market grows at this rate, it typically does lead to some downward trend at some point, some type of correction. Looking at it from a sector perspective, and people at Global Macro Monitor, which is a blog site that I frequent, because they do a very good job of showing it from a sector perspective. You can see here, overall, most of the sectors actually performed ahead of the S&P in 2016. Now they said at 9.6. I think they looked at it a little differently than what I saw from Fred, but you can see overall energy did very good in 2016. It had a bad year in 2015, so it really couldn't go anywhere more. It couldn't go any better than anywhere more than up. Telecom didn't win well. All the industries did very well in 2016 except for healthcare. And I think that that's just a sign of the continued challenges that industry is facing as a result of the changes in the market, the Affordable Care Act. There's a strong proliferation of new drugs out there that are very expensive, that are causing some challenges for insurers as well as for companies that provide insurance coverage. There are issues now, as some of you all have probably seen some of the work that's something that probably is going to be a bigger issue that's going to come up for particularly drug companies this coming year, has to do with access to opioids, and whether or not drug companies and wholesalers and the industry is doing enough to really prevent opioid abuse. There's been a lot of journalism that's been done out of West Virginia showing that while it may not have been explicit engagement, that there might have been some implicit involvement between the various companies in not really doing enough to stop opioid abuse, which was primarily facilitated through prescription drugs. So that is something that is out there that is probably going to be a concern, particularly if politicians decide to grasp upon it in the coming year. Congress decides to look at it, the president decides to look at it, that could be a problem. This is starting to come out because some journalists have won some battles over information. There was an article that came out around Christmas time in West Virginia that led to it. And now also some companies, including wholesalers, drug wholesaler companies, are now starting to settle lawsuits that were brought by federal and state by state investigators in West Virginia, as well as federal investigators, regarding their actions with respect to this. They are starting to go back into the supply chain and trying to figure out how is it that, in the case of West Virginia, a large segment of the population, but many other states it's the case, a large segment of the population became addicted to opioids as well as gained access to opioids. That's what they're really starting to look at. Looking at January, you can see pretty much everything is in the positive range. except for utilities and energy. And I think a lot of that has to do with the weather, as well as perhaps some concerns about demand going forward, some concerns about lack of economic growth in other parts of the world. Hope to have some time to talk about that in a little bit. When we look at the markets, obviously volatility can be a concern, or stress in the markets. Both of these measures, the St. Louis Fed has their own financial stress index that's in blue. There is one that's that's coordinated with the S&P, volatility. And as you can see, overall, compared to where they've been, they're relatively muted. So not really a concern right now, even though that does not mean that there won't be corrections, but there's not expected to be any massive sell-offs or any massive change coming in the near future. Also, with respect to treasuries, we know that interest rates went up at the end of this year. There's expected to be continued increases in interest rates. Wells Fargo's economists are anticipating 2 Fed interest rate hikes this year between now and the end of 2017. So we're likely going to get up to above 1% interest, probably to by the end of the calendar year. And that has, of course, resulted in some increases in treasuries. But you look at where they are compared to where they were five years ago, they're still kind of in that range, and they're still significantly below where they were, say, 10 years ago. So overall, treasuries are still in a low range that is still affordable, which means overall the ability of the federal government, when it comes to treasuries, the ability of the federal government to pay the interest on its debt, which continues to grow. It's crossed the 20 trillion threshold. If not now, it's going to cross it pretty soon. That indicates that is still manageable. Needs to be fixed, needs to be addressed, but we're not seeing any significant interest rate spikes at this point, particularly with respect to treasuries. Hopefully, though, treasuries do raise an interest so that that type of investment, that more secure investment, is available for saver class and for others to actually be able to see some rate of return on. Now looking a little more at the actual health of industries, industrial production. These indices kind of show where we are with industrial production, and as you can see, 100 would be the mark for 2012, and you're seeing that that manufacturing is showing some continued upswing. Overall, manufacturing has moved in a positive direction. Manufacturing productivity has done very well. Now, of course, that's not necessarily tied to employment. That's tied more to modernization and technology. But manufacturing as a sector has done well. It's just not necessarily showing it in the more traditional ways that we're used to it. But overall, industrial production did lag a little bit since the end of 2014. But you can see there that December number saw a significant uptick. There is an expectation in the industrial sector that there's going to be greater capital investment coming as a result of the Trump administration, partly tied to what the government is going to do from an infrastructure perspective. There is going to be some kind of infrastructure plan. Don't know how big it's going to be, but there will be something. But also the likelihood that there is going to be some changes in tax laws and some changes going on in other areas of the economy that's going to lead to greater private capital investment. Both of those are expected because in general, in this recession, capital investment has lagged overall. Business inventories remain high. This is, you're looking at about $1.8 trillion of inventory that's out there. This really didn't change much since 2015. You probably have seen some articles about ships sitting out, not about lack of ship activity, lack of train activity. Some of that activity is starting to pick up, but in general, inventories remain at high levels, and a lot of that's just tied to whether or not companies are out there buying. When you look at exports, you can see that growth that we have done very well with exports in the last couple of years, but there's starting to be some slippage. Part of that is due to the strong dollar. A lot of that has to do with the strong dollar, and we don't know yet if perhaps these numbers are going to go down or not due to anticipated trade issues. Now, what I will say is, while there has been growth in exporting of goods, we have really seen significant growth in the last couple of years in the exporting of services. So it is not just based on good export growth. And the fact that there is service growth as well, that's probably an indication that even if we do have challenges with respect to trade, that it's not going to be as significant or as extreme, because you do have a greater diversity of products and services that we export, particularly on the service side. So that should help us with respect to maintaining the position where we are with respect to exports. Overall, when you look at our trade balance, you can see that it does fluctuate at about the $40 billion mark, but you see that it's kind of staying the same, and perhaps it'll go down. We just don't know at this point. But in general, it has remained relatively stable since 2013, with just minor peaks and valleys, and a lot of that's tied to energy activity, but also some types of manufacturing. Now, we've kind of gotten through showing you some information about where we are currently, and trying to now think about what is it that we need, what is it that could happen, looking at some of the other challenges that we have in this new normal that we've been in for 10 years. And you could argue that what has happened with the election in 2017 was that it was basically a referendum on, you could say that the last 8 years under President Obama was the establishment of this new normal in economic activity or economic performance for the United States. And you could argue that the election was a referendum on, are you satisfied with the new normal? And the reality was, enough voters in enough states, a majority in enough states, particularly those states that have not benefited from this new normal, said, we're not happy. And they want to push beyond it. They want to see where we can go. And we need to kind of get an idea of, what do we mean by that? So let's take a look. We're going to look at employment. We're going to look at housing. Those are areas that we need to take a look at. If we look at where we are for 2016 employment, we saw about 1.8 million more jobs created in 2016. We're now a little over 152 million people employed. As you can see, that's about 6 million ahead of where we were in the recession. But during the recession, we lost about 8 million jobs. So when we started this decade in 2010, we were at around 138 million. So since then, we've gained about 14 million jobs. But I'm going to show you in a second, just because we've gained 14 million jobs doesn't necessarily mean that we've seen the type of growth and economic activity that we've seen in other times when we've grown jobs at a rate similar to what we've lost. I mean, when you think about that, that means we've had about 10% job growth since 2010. But does the economy really show what we typically think of when we think of 10% job growth? The good news is that there's still a lot of room for growth. This is a report that ties in openings, layoffs, discharges, and quits. The key thing to look at, of course, would be job openings. Still, there are over 5 million openings. We've been at over 5 million openings since 2015. That number continues to remain strong. That's an indication out there of a skills gap, possibly even a little bit of a wage gap. But the real issue that I think a lot of employers are finding is the skills gap. And it also ties with respect to skills and location. There is, I think, there's going to need to be some consideration about where jobs are located and concerns about migration. We have not seen the level of migration that we typically see with respect to perhaps the middle class or the lower middle class. We have seen continued migration in the upper class, and we've definitely seen that with respect to the younger upper class, those who have been in a position, whether they be millennials or Generation Xers, who have moved into metropolitan areas to take jobs in technology and health services and information and finance and in corporate. But we haven't seen that same level of migration with those who are in perhaps the trades or lower skilled or perhaps more blue collar jobs. We have not seen that migration. And when you think about the Depression, and just I'm using it as an example, even though we have not called what's happened in the last 10 years a depression. When you think about one of the things that happened during the 1930s was there was a tremendous migration of population of blue collar workers or the low medium skill worker class from areas where jobs were not there to areas where jobs were available. That did happen. There was a lot of migration. Towns did dry up and go away in places where those jobs were not available, and large cities like Detroit and Chicago and Indianapolis and other places grew. That has not happened in the same way this time around. And a lot of these openings are in areas where it's just simply a lack of skill. But a lot of these are also in areas where the jobs have moved to. And that is something to kind of keep in mind. So it's, in a lot of cases, it's not just tying jobs on the basis of skill level, it's also tied in terms of location. And not every job is something that can be done remotely. There's a lot of trade work that has to be done physically in a given location. But as you can see, quits have gone up a little bit, which shows that people are starting to move into other jobs or starting to take other jobs. And layoffs and discharges remain relatively flat. What that has resulted in is that we have finally achieved recovery, and it was during the last 12 months, you could say, in wages. Now, this is median weekly real earnings. So these are earnings adjusted for inflation for those who are wage and salary workers 16 years and over. So this is everybody. This is the broad measure of everyone. And this includes those who are hourly workers, and those who are those also include hourly workers. And what you see is that we're finally seeing growth from where we were back in 2009. It's really interesting that there was actually a bump up, and you can tell, how did that happen? Well, a lot of that was due to, some of it was due to the stimulus that occurred in 2009, and also was the fact that people did raise wages in order to help cover energy costs. But as you can see, once the recession kicked off, that did subside. And a lot of that also in 2009 was also due to the crash in the energy market that occurred during the recession as well. But you can see that there was a kind of a downward trend in wages as the economy picked up. But now you're starting to see that we've finally gotten back to where we were during that recessionary period in 2009. We're finally back up to that point, and we've started to go above it. But at the same time that we talk about, hey, we've had this 10% growth in jobs, we have a lot of openings, wages are starting to pick up. The reality still is we're not where we need to be, and particularly when you look at labor force participation. And this is important because if people aren't working, what are they doing? And for me, who works in government, there's a little bit of a concern about what does this mean from the standpoint of providing services and other needs. But there's also the issue of their ability to be productive and to contribute and to be a part of actually growing the economy. We obviously want, I'm an individual, I do believe in individualism, and I do want people to pursue what they want to pursue. And at the same time, hope that what that means is that their own individual pursuits are going to contribute to the economy overall. And we kind of, one way to look at that is through labor force participation. Doesn't mean that they're working necessarily for someone else, but are they in the labor force? We have seen a little bit of a pickup, but as you can see, during that strong period we had in the 80s, we saw labor force participation for the broader population go up to about 2/3 of the population. Back in the 1960s, it was about 50%. That was before we started seeing the large scale induction of women into the workforce that occurred from the 1960s and 70s into the 80s. So that obviously changed the dynamics and created tremendous productivity that helped us grow our economy in the second half of the 20th century. You also have labor force participation for those in those key employment years between 25 and 54, whether you're someone in the trades or someone in a white collar job. It's the fact that during that time is your peak productivity, that 30-year period representing the peak productivity of the workforce. And that group was at almost 85% during the 90s and the 2000s, and both have seen declines, most notably in the population as a whole. Some of that was expected due to retirement, but what we haven't seen is a recovery of that population. At the same time, we have also noticed that in the prime year population, the 25 to 54 group, their participation is down. And it has started to pick up a little bit. It did start picking up in 2016, but it's not picking up yet at a rate to really be able to sustain the need for economic growth, because we do need more people contributing to the economy, particularly because our society does have an entitlement system. Whether it's the formal entitlement system that we have in government, or it's the more broader informal entitlement system that we have in terms of providing for our neighbors and one another. Those are things that entitlement structure requires that we have a population engaged in the economy. That is something we have to take into consideration. So, hopefully, the best thing that we could see in the next couple of years is to see dramatic improvements in labor force participation. And that would help in a lot of ways, because it would likely reduce dependency and increase contributions into the economy overall. So now we go into the home sales area. And 2016, if you were a realtor and you did your job, you had a good year in almost pretty much every market in the country. Sales went up on new homes. They did decline a little bit towards the end of the year, but overall, when you look at this information is produced by Wells Fargo, and they like to do charts for broad periods of time. But you can kind of see that there's been an upward curve, and it's continuing to grow. It's not where it was prior to the recession. We're still not there, but we have seen growth and continued growth. Where we were prior to the recession, given what where the mortgage industry was at the time, was completely unrealistic, and I doubt we will see anything like it again for a very long time. It'll be very similar. Historically, it'll be very similar to what was going on with the margin stock industry prior to the Great Depression, prior to the stock market crash of 1929. Interest rates remain at relative historic lows, as you can see there, but they have gone up a little bit in recent years, and that has started to put a little pressure on people buying homes. But in reality, this time of year, while there are people who do go out and buy and there is activity, there's also a cyclical nature, and I think you will hopefully see activity pick up in the spring. Regionally speaking, the South, the light blue in the lower right, you can see has had a good time and has recovered in a lot of ways. Has had strong recovery, even though the annual rate did go down a little bit towards the end of 2016. Those are for new home sales. And I would argue in a large part that is also being tied to a lack of growth and development, except in key markets. Looking at existing home sales, they're actually doing pretty well. The biggest challenge now that we're seeing with existing home sales is low inventory. You look at that one on the bottom left, and you can see that inventory now, for the total inventory of existing homes for sale, this is nationwide, is at around 1.65 million homes. It's the lowest level that there is on that chart. And that chart goes all the way back to 1999. So what that tells you is that there's not a lot of inventory available. And some of that inventory is not necessarily in the best condition. That's everything. That includes that probably includes homes that are listed by HUD. That includes homes that are foreclosures. That includes homes that are on the market that are there, but aren't necessarily the best buy in terms of the value compared to the quality of the house or the location of the house. There are going to be neighborhoods where they're going to see a lot of for sale signs, but that does not. So you also got to take that into consideration. In a lot of markets, and including Rocky Mount, inventories are at historic lows. And it is starting to create a challenge for realtors, especially those who are trying to sell. But it also means that it's time to start looking at the supply and saying, maybe it is time to start really increasing supply in the market. And that gets now to start. What we have in the pipeline. The annual average has continued to pick up at around 1.2 million at this point. But as you can see, that 3-month average still favors multifamily housing above single-family housing. That shifted in the post-recessionary period. And I mean, if you spend a lot of time in Raleigh or spend a lot of time in major cities, you have noticed that a lot of the growth and development of the housing market has been in major metropolitan areas, and it is leading to a lot of multifamily or apartment housing particularly for young professionals. It's a lot of housing that's more intended for singles or for young couples. It's not as much family. It's not as much intended as family housing, though it could work that way. But there's still a preference, even though the economists say it's starting to drop off. There is still a preference with respect to multifamily development. And again, if you spend any time in Raleigh, you see it all over the place. And it is certainly now starting to drive decisions with respect to retail development and other factors. But you can't go anywhere in a major city like Raleigh or Nashville or many of these other growing parts of the United States without seeing massive multifamily growth. And hopefully we're going to start seeing some single family growth. But one thing I'll mention that I didn't include in here, and it came from the Raleigh Outlook event that was held earlier this month. They mentioned that about 15% of the single family development that is going on right now is actually redevelopment of existing property. And what they really mean by this is a lot of it is homes, lots that are being bought, homes being torn down, and new homes being built on it. And I can attest that there's a member of my family or a property that was owned by members of my family where this has happened in Raleigh. In a lot of cases, location, desirable location is desirable location in existing areas. So instead of it being purely the development of new housing communities and new suburbs and new areas, you're seeing a lot of redevelopment, even if that means tearing down existing homes. Whether it's, single lot, we're going to replace one small home with a bigger home, or you see a redevelopment of a neighborhood where many smaller homes are torn down and replaced with many larger homes or many newer homes in a lot of cases to provide the housing that people are desiring. Those are the case. And you can see that is where the growth is right now. And of course, what that means is we're seeing price recovery overall in the market. So now, as you can see, that appreciation is continuing. So now we come to Rocky Mount, and the information I have to share on Rocky Mount is pretty good in terms of where we are in more recent history. First, talk a little bit about the real estate. Local housing market is growing, and again, we want to thank Kathy for providing us with this information. The 2016 information is really good. We saw the average list price go up by about 4.8%. We also saw the average sold price go up by over 3%. And when you look at the 3-year trend, we've seen our sale price go up by about 10%. And we're seeing listings going down, also the number of homes being sold going up, and then the days on market is also going down. Just in the last year, that days on market was reduced by 2 weeks. So that's a good sign. Overall, these signs are really good. Now the challenge, and Kathy alluded this to me as well, even in this market, is finding inventory. Our inventory right now, according to Kathy, is at its lowest that it's been in a very long time for the Rocky Mount MLS. Also, just to note, Rocky Mount's MLS has changed recently to where it is now aligned with listing services across Eastern North Carolina. So if you are a realtor or someone who looks a lot at the listing services, you may notice that we're now part of a larger listing group. You've also noticed that we do have pretty significant visible redevelopment here locally, as well as new development. There is some new housing being developed now in some neighborhoods surrounding Rocky Mount, as well as some infill inside Rocky Mount proper. We've also, of course, seen redevelopment and a lot of cases bringing homes that had not been occupied back online. Rocky Mount Mills being perhaps the most noticeable of these. These are some of the first group of homes that were redeveloped in Rocky Mount Mills. And if you drive through that area now along River Road, or you drive near the mill property, you will see just tremendous redevelopment. If you had not been there 18 months, if you'd been there 18 months ago and hadn't been there since, you'd ask yourself, how is this even possible? In some cases, you would think they tore the homes down and replaced them. They did build some new homes, but for the most part, they have been redeveloping existing housing. This is predominantly rental housing, but it is market rate rental housing, and that's really where the demand is right now. A lot of people, including people who are trying to recruit professionals to this area, have made the point of mentioning that Rocky Mount does not have a lot of attractive market rate housing. And this is something, when looking at some of our existing multifamily products and others, that needs to be addressed by developers and investors, hopefully in the immediate future. Looking also at employment growth, I've got some charts to follow up with this, but I did want to provide the tables. We've been kind of, for the last couple of years, when we've looked at on a metropolitan level as well as inside the city, our employment, we've had some employment growth the last 2 years. At the end of 2014, at the end of 2015, we had employment growth of about 1%, 1.5%. It looks like this year, and the December numbers will actually come out tomorrow. I wish I had them today, but they don't come out until about 10:30 a.m. tomorrow morning. But I anticipate that we are going to see 2% employment growth for 2016 for the metropolitan area, and likely see 2% growth for the city. So what that means likely is you're going to see about 1,300, 1,400 new jobs growth in the metropolitan level, and probably around 450, maybe even 500 jobs for the city. So that's a sign that we're continuing to show some growth. This is kind of where our trends are. We do kind of have a cycle now when it comes to our activities, the light blue being the employment level, the orange being the labor force. I'm going to focus more on the blue. We do kind of have a lull in the late spring to late spring and summer that picks back up in the fall. And I will go ahead and tell you, this lull is created by, I guess you could say, this lull is created in large part due to the teaching profession. It's also driven by the fact that more manufacturing, particularly the type of manufacturing that's done here locally, there is more of that manufacturing that's now seasonal in nature. So those are things we have to consider. But overall, net employment activity is growing, and this will be our third consecutive year of employment growth if all trends hold, and it will be at a faster rate of growth than we've seen the last 2 years. In terms of where that growth is occurring, we have seen some growth in manufacturing in recent months. We also seen retail continue to grow, as well as in the logistics, trade, transportation, utilities. The good news is that we're seeing that goods production and services, particularly in the last month, this was November, have grown, but we still have a ways to go in terms of growing overall. As you can see, when we compare to other metropolitan areas, we're still working. Now, those numbers that we were at for the metropolitan area and for the city are better than where we were, say, a couple of years ago, where they were in the double-digit declines. We're also not the only area that's still struggling to recover back from where we were in January of 2008. But obviously, there have been other parts of the state. And this disparity, I think, is something that has not really been addressed very well. And I think it has led to some of the challenges, to some of the opinions and some of the responses that people have had to what's going on in the economy. And I think it does contribute to the environment that we are now in and the environment that led to the results that we saw in November's election. When we look statewide, what you see is you look at those blue lines, which show you where the employment has grown since January of 2008. You can see on the state level, it has grown in the professional services, and that includes hospitality. And in fact, if I go back for a second to Rocky Mount, you'll notice the hospitality industry, we have seen since the recession almost 8% growth in that sector here locally. So it's been one of our stronger performing markets in the stronger performing sectors of the economy in the post-recession period. And that's also true at the state level, where it's grown about 20%. So we've done well, the state's done well, and if we can find more opportunities to catch up in that area, that would be good, as well as catching up in manufacturing and health services and other parts of the economy, especially including professional services, where the most growth has occurred statewide. One good thing for us is that we have also seen the last couple of years that we have seen some significant improvements in per capita personal income. We saw that in 2014, and we've seen it in 2015, where we were at or above. We were above the state in 2014. We were close to the state wide number in 2015. And I would anticipate that that same trend is going to continue for 2016, which will be a good sign for us in terms of personal income, because that is another contributor to our overall gross domestic product. And we are a little more volatile in this area. As you can see, when we go back to 2006, both that year, both the state of North Carolina and Rocky Mount's metropolitan area saw similar growth of about 5.5% that year. Since then, it's kind of been all over the place. But 2015 was a great year for us. We actually had near 5% growth. We had the highest, I believe we were the first or second of metropolitan areas in the state in terms of GDP growth in 2015. Overall state growth, according to this measure, was around 2%. So there is room. We do have the potential, and we are trying to do our best to catch up with what's going on statewide and nationwide. Now, time to talk predictions. I don't do a lot of predictions. I may tell you kind of where I think certain things are going to come out at the end of a year, but there are plenty of people out there who do provide predictions who are far better at this than I am. First of all, looking at some indices or indices of confidence in sectors, perhaps the biggest group to show the biggest level of optimism and positive outlook after the election was the small business community. Small businesses had kind of been, since the recession and even before the recession, kind of in a lull. And a lot of that was because they were having trouble with markets, they were having trouble with capital, they were also having trouble with regulations, taxation, and of course the challenges with healthcare reform. Now, after this election, they see great opportunity, and as you can see, that led to some significant improvements. This is back in December when they had a chance to kind of digest what happened with the election. And as you can see, according to this monthly survey done by the National Federation of Independent Business, small business optimism is actually now back above 100. It had barely been above 100 since the pre-recession period. Actually, go back to around 2007, and it was briefly up there for the elections in 2014. It's back up there again, and hopefully this will be a sign. Obviously, we want to see where this is in a couple of months from now to see where we're going. Consumer confidence is feeling better. This is a measure of consumer sentiment by the University of Michigan. it's improved some. There was again another sharp improvement towards the end of 2016 after the elections. They are the area that some economists, including those at Wells Fargo, have been pointing to has been the area of capital investment. This is information that's provided by Dodge data, not to be confused with Dodge, the car company. It's called what they call the Dodge Momentum Index. And overall, what they see in terms of these areas of capital spending, including construction, they think that there's going to be some capital investment made in the coming year. That trend had already started to pick up last year, but it is going to continue and probably accelerate even further in 2017 and 2018. That, of course, these factors, as well as the employment picture right now, the openings, the continued decline of new filings for unemployment is leading to an improvement in what's referred to as leading economic indicators. That index has continued to show improvement, and the coincident, which is kind of looking at where we are now, there's a symmetry to where they're going, and that's a good sign. If they track in the same direction, if they're tracking consistently, that's a good sign overall for the economy. So, in general, don't expect things to just go gangbusters, but some things are improving. The National Association for Business Economics back in December came out with an outlook. They do expect to see improvement in GDP between 17 and 16. They were thinking it was going to be 1.6, and there may be some further adjustments to where we are on GDP for 16, but they do see improvement for 2017. And they don't think that we're going to hit what they call cycle peak, which would mean you start seeing a downturn into another recession. They don't see that happening. They do see some challenges with respect to energy, with respect to the strength of the dollar and some other factors, but generally they're in a positive mood. The people at Wells Fargo were looking at around 2.5%, if I remember correctly. There are two economists in North Carolina that do a lot to kind of make some predictions and projections about where we're going economically. The first I'll show is Dr. John Connaughton. He is with UNC Charlotte, and he did forecast 2% growth for 2017, along with a continuation of a 5% unemployment rate. He, along with Dr. Walden at North Carolina State University, Dr. Walden perhaps better known by a lot of people here in Eastern North Carolina, do see that while they do see job growth increasing, they do see more people going out to look for work, which is why they don't think the unemployment rate is going to go down, even though they do think employment is going to pick up. A little more data was provided by Dr. Walden. Dr. Walden does his own index of leading economic indicators for the state. He finished up the one for January. A slight increase for the month and about a 1% adjustment compared to last year. But overall, those numbers are in pretty good shape. So overall, the indicators, looking at it from a state perspective, are in a positive direction. And also, he did make some other predictions. He's actually anticipating about 2.6% growth, but he had 2.3 for 2016. So but again, he's probably in the same line with the people at Wells Fargo, where I can feel comfortable saying that if we hit 2.5, that would be a good thing. See some growth in the labor force, sees growth in jobs growing ahead of the labor force, and see some continued real wage growth, though not perhaps as significant as what we've seen in 2016. Thank you all very much, and have a great and prosperous 2017. And we're going to put another one together here probably around April to kind of see where we are at the end of the first quarter, and look forward to presenting it to you then.